3% jump in Brent crude overnight while the ceasefire cracks. Your money is watching this war scare turn into an inflation trigger before lunch. Wednesday, July 8th, 2026. Like and subscribe for daily market updates. Today's agenda: Hook Market Snapshot, Geopolitical Status, Macro and Central Banks, Earnings, IPO and Deals, Closing Summary. Up next, Market Snapshot. The summer's biggest fear just came roaring back, and it landed on the worst possible day. Overnight, the United States launched fresh strikes on Iran after Iranian forces attacked oil tankers near the Strait of Hormuz. The ceasefire that calmed markets in June is now cracking, and oil has spiked. It's Wednesday, July 8th, and this energy shock hits just hours before the Federal Reserve reveals, in the minutes from its last meeting, exactly how close it is to raising interest rates. The one thing that could force the Fed's hand is higher inflation, and oil just gave it a reason. Let's break it down. Here's why the oil numbers matter so much. The mood flipped hard. After Monday's record, stocks fell across the board Tuesday as the news broke. The Dow slid about 0.25%, giving back the 53,000 level to close near 52,900. The S&P 500 dropped just under 0.5% to around 7,500. And the tech-heavy Nasdaq fell more than 1%. This is a classic risk-averse move, money running from anything speculative toward safety. The US dollar climbed as investors sought a haven, and the fear gauge, the VIX, ticked up from the unusually calm levels it held all last week. One milestone got buried in the noise. SpaceX officially joined the Nasdaq 100 on Tuesday, the largest company ever fast-tracked into the index. But on a day the whole market was selling, even a wave of forced index buying couldn't lift the mood. It's a jarring turn after a first half of 2026 that ranked among the best in years. The S&P finished the half up nearly 10%, and small-cap stocks logged their strongest opening half in over 3 decades. Early Wednesday, the panic looked contained. U.S. futures were roughly flat as traders held their breath for the Fed's minutes. That brings us to macro and central banks. The story driving everything today began Tuesday, when Iran's Revolutionary Guard fired on 3 commercial ships near the Strait of Hormuz, a narrow waterway carrying roughly 1/5 of global oil supplies. A Qatari gas tanker caught fire, and a Saudi crude tanker was damaged. No casualties were reported. In response, the U.S. revoked its license for Iranian oil sales early Wednesday, followed by military strikes on sites near the strait. Maritime authorities raised risk levels to severe. This action shatters the fragile truce signed last month that aimed to end a nearly 4-month war and reopen the waterway. President Trump, arriving at a NATO summit in Turkey, warned both sides must reach a deal or face U.S. intervention. Meanwhile, Ukrainian drones struck Russia's largest oil refinery this week, confirming energy arteries are under pressure on multiple fronts. A possible off-ramp exists. Strikes occurred during Iran's supreme leader's state funeral, and negotiators expect peace talks to resume once it concludes later this week, suggesting the situation could cool as fast as it flared. For markets, the math is simple yet unwelcome. Any threat to Hormuz raises oil prices, driving inflation, the exact problem the Fed fights. In commodities, oil absorbs the shock first. Brent crude jumped around 3% to settle near $74 a barrel before climbing toward $76 after the U.S. revoked Iran's license. West Texas Intermediate leapt to approximately $72. This marks a sharp reversal from days ago, when prices hovered near 4-month lows amid hopes of cooling conflict. Context matters. Earlier war phases drove crude above $100, sparking global inflation fears, precisely why traders treat today's flare-up as more than just headlines. Here is the twist most overlook. Gold fell for a 4th straight session toward $4,100 an ounce, despite being a safe place to store wealth. Why? Because this shock functions primarily as an inflation story. Higher oil keeps the Fed in favor of higher rates. High interest rates crush gold prices. The commodity board's message is blunt. Last week's calm is gone. Fear showed up fastest in crypto markets, which sold off alongside stocks after years of pitching Bitcoin as a hedge against government and energy chaos. Instead, when strikes hit, Bitcoin traded like any other risk bet. It briefly popped above $64,000 Tuesday afternoon before slipping to around $62,700 by morning. Ethereum mirrored this pattern, spiking to $1,800, then falling back into the mid-$1,700s. Smaller coins took harder hits. XRP and Solana each dropped 2 to 3%, while crypto-linked stocks suffered more significantly. Strategy fell over 3% and Bitmine nearly 5%. Underneath these moves, about $300 million in leveraged bets were wiped out daily, mostly traders positioned for price rises. Investor mood has slumped back into extreme fear. However, the longer-term rotation flagged all week remains intact. Money continues flowing from Bitcoin funds to Ether funds, and big Binance buyers stepped in during the dip. Make no mistake, today crypto is not a safe harbor. It rides the same storm as everything else, while awaiting this afternoon's Fed signal. For scale, the total crypto market stands at roughly $2.2 trillion, with on-chain data showing an increasing share of coins now sitting at a loss, a sign of how much last month's slide has bruised ordinary holders. Bitcoin isn't acting like a hedge today. The main event occurs at 2 p.m. Eastern when the Federal Reserve releases minutes from its June meeting. This release is critical because Chair Kevin Warsh leads a committee focused on rate hikes rather than cuts. The benchmark rate currently stands between 3.25% and 3.5%. During that June session, 9 of 18 officials penciled in at least one increase for the year. Additionally, the Fed's inflation forecast was sharply revised upward. Its preferred gauge now runs above 3.5% this year, far exceeding the 2% goal. Traders are so wary they have begun pricing odds of a rate hike as soon as December. Warsh has signaled he will abandon his old habit of telegraphing future moves, leaving investors hungry for clues. The timing is particularly harsh. Minutes drop on the very day an oil shock revives inflation threats. Last week's soft jobs report cooled hike bets to roughly even odds for September, but if the minutes favor higher rates and oil climbs further, that math changes quickly. The 10-year Treasury yield sits near 4.5%, waiting. With no fresh Fed forecasts until September, these notes offer investors their clearest window before the July 29th decision. Which leads to closing summary. Set aside geopolitics, attention shifts to the corporate calendar. SpaceX's entry into the Nasdaq 100 triggered widespread optimism in Wall Street coverage. Citigroup outlined a path towards significantly higher valuations, while Morgan Stanley initiated coverage with an equivalent buy rating. As required by index inclusion rules, funds purchased approximately $4 billion of shares upon the stock's debut. Yet, this enthusiasm could not stem the market's prevailing risk-averse tide. The broader lesson is that index inclusions alter ownership structures rather than intrinsic value. Historical data confirms initial price spikes often fade over time. Looking ahead, the second quarter earnings season begins with consumer-focused companies. PepsiCo reports Thursday, and several analysts have already lowered their profit targets for the company. Delta Airlines follows on Friday. Both stocks carry heightened importance in this environment. Rising energy prices are once again impacting costs across the economy. Consequently, these two names serve as early indicators of whether American consumers can maintain spending habits, while expenses climb from gasoline to airfare. Investors watch closely to determine if households will continue buying despite inflationary pressure. The results for PepsiCo and Delta will provide critical data on consumer resilience before other sectors report later this month. Market participants expect volatility around these releases given the macroeconomic backdrop. Analysts remain divided on whether current valuations reflect realistic growth expectations or over-optimism regarding future demand. Regardless of individual stock performance, the earnings season offers a definitive test for economic health in an inflationary environment where every dollar counts more than before. Finally, let's turn to closing summary. So here's where we stand this morning. The mood has flipped from record-setting calm to risk-averse tension in the span of a day, and the whole market is now trading two stories at once: a widening conflict in the Gulf and a Fed that could still raise rates. The single biggest risk is that those two collide, oil keeps spiking, while this afternoon's minutes sound in favor of higher rates, reviving the rate hike threat and hitting stocks and crypto together. The single biggest opportunity is the reverse. The Gulf tension eases, the minutes read soft, and this year's rally gets its footing back. Watch three things in order: the Fed minutes at 2 p.m. Eastern today, the headlines out of Hormuz, and then next Tuesday's inflation report on the 14th. The calm is gone. Now we find out how the market handles the storm, and whether this year's remarkable rally was built on solid ground or borrowed time. If a clear, honest daily read helps you cut through the noise, do us one favor: subscribe, and we'll see you tomorrow morning. The mood flipped hard from record calm to risk-averse tension in the span of a day. The whole market is now trading two stories: widening conflict in Gulf and Fed that could still raise rates. Single biggest risk is those collide. Oil keeps spiking, while afternoon minutes sound in favor of higher rates, reviving rate hike threat hitting stocks crypto together. Single opportunity reverse. Gulf tension eases minutes reads soft year rally gets footing back. Thanks for watching Market Pulse Daily.